For those of you that don't know Tim, Tim is one of the partners at ProVision, our firm here in Phoenix, and works with a lot of investors and business owners, and in my opinion is one of the smartest tax strategists and the group there in the country, easily. And you'll hear nothing but good things from clients. My personal experience working with Tim is he's the best, and he's got great information, so you guys are going to learn a ton. And some of you are probably going to want to engage and talk with him further. So I'm pretty sure that's an option. Definitely ask questions, and we'll do what we can. You're going to do a presentation, and then we'll do some Q&A. That's the plan.
Correct.
Okay. All right. Well, why don't we do that? If you want to share your screen and go through your stuff, we're going to be talking about some things like the net operating losses and some other stuff with CARES Act. And then if there's other stuff you guys have, I know some of you have some specific questions. We can do some specifics, and if it gets too granular, we'll probably take it offline, but it might be granular enough to be beneficial to everybody. So we'll just kind of go with the flow. But put your questions in the Q&A, and we'll make sure that we go through those, and I'll kind of monitor those at the end. So Tim, why don't you go ahead and roll?
Perfect. Thanks, Dave. Can everyone see my screen? You see my screen, Damien?
Yeah, you're good.
Perfect. So as Damien said, we're going to do just a short presentation and a question and answer. As he alluded, I'm a partner at ProVision. We're a firm in Tempe, Arizona. Our goal and our reach is for entrepreneurs, small business owners, people that really control their own destiny. It's really fun to work with entrepreneurs who have the ability to really change their circumstances and facts to be able to be as efficient and lean as possible, to be as to maximize their wealth generation through tax savings, and also using that capital to invest in other opportunities. So ultimately today, just wanted to go over some of the things I'm going to touch on briefly, some of the things in the CARES Act, things that you might have already heard of, things that you didn't. There is a lot of information. If you'd want to see the slide presentations or email them out, you can definitely reach out to me, and I'll shoot them out, or if Damien wants to shoot them out, he can. So a little bit about me. I'm a certified public accountant in both Arizona and North Carolina. I've been with ProVision going on 10 years now. I've been in public practice for about 19 years. My focus has always been high net worth individuals, whether entrepreneurs or C-suite employees, really working to try to drive down and benefit from the higher tax rates and the higher tax percentages, and really get the best bang for our buck. So the CARES Act came into play in March 27th of 2020. It was signed into law. And really what its goal is to help small businesses really manage cash flow during this event. And so their goals were not only to help individuals that might be furloughed and out of work, but also to help and really keep small businesses moving forward, keep small businesses cash heavy so that they can ultimately pay employees, and really try to keep the economy limping along until this subsides and everything can go back to the way it was. As you can see, if you follow the news, there's already talks of another act coming out that's going to be more specialized to other arenas and other specific sectors of the economy. I expect to see much more come out and more acts come out. I think we're going to see an act probably every couple months for at least another 12 months as we try to weather the storm. So really this first act, the CARES Act, helped out in several ways. It created this idea of a PPP loan, which everyone's heard about, and there's been a lot of reports in the news. They created retirement plan incentives, ways to get money out of your retirement plans without penalties, utilizing loans or repayment schedules. They also introduced or reintroduced this idea of an NOL carryback. In 2017, with the 2017 Tax Act, they removed carrybacks for NOLs and made them infinite carry forwards. The CARES Act really brought this back into play as an opportunity to do a cash grab, to be able to allow small business owners to go back and maybe gather funds from taxes that they had paid in prior years to, again, help with cash management and cash flow. So first off is the Paycheck Protection Program, or people call it the PPP. It was available to small businesses, available to self-employed and sole proprietors. The original plan was that it was going to be a loan that was up to $10 million. It had repayment. That repayment was a 2-year maturity, so you had 2 years to pay it back, and the interest rate was 1%. The deferral, so the first 6 months, you don't have to worry about payments. Again, from a cash flow perspective, trying to get as much money into the end consumer's hand as possible and not worry about paying back. With these paycheck protection programs, they did have this opportunity for forgiveness. So ultimately, they said if you use it for certain covered expenses and you utilize these funds within 8 weeks of getting the funds, then you could potentially be forgiven and not have to pay this back. But ultimately, if you did have to pay it back, this is it. This is what it looks like. It's a 2-year maturity at a 1% interest rate, which is pretty phenomenal interest rate for a non-collateralized, pretty much simple, no background check type of loan. The use of funds needed to be done covered costs. So everyone's talked about what that covered cost is. A lot of it goes into payroll. So they wanted you to utilize it to keep employees employed, or, you know, keep employees being paid. So majority or large chunk of it needs to be headed towards employees. So payroll costs, healthcare costs, but then above and beyond that, you had the ability to use a portion of it, or you can use a portion of it for non-covered costs or non-specific costs, non-specific payroll costs to be precise. So ultimately, you could utilize it to pay your rents. You could utilize it to pay your utilities. And when we talk about utilities, that's everything from, you know, water, gas, electric. They have something called transportation. I'm not quite sure what that means, but that's also includable in it. Interest on debt obligations. So ultimately, they haven't been really precise in what this means, but it really is interest on any obligations as is written in the code, any obligations that you had prior to February 15th, 2020. If you pay using this, you can utilize these funds to pay the interest on those obligations. And then the last one, which is a lot of people had talked about getting what are called EIDL loans, the economic injury disaster loans. You have an ability to, if you had gotten one of those, to ultimately refinance it and utilize the funds from your PPP loan to refinance. So the major thing that everyone wants to talk about and what the focus is what is the loan forgiveness and what does it look like? There's still a lot coming out, and there's a lot of changes that are being made and a lot of interpretations, and there really hasn't been final guidance. The AICPA, which is the American Institute of CPAs, has sent some letters to the Treasury Department to try to get them to clarify and maybe change things a little bit, but this is what it looks like now. Again, it could change in a month or 2 months from now. So really, as long as you use the funds within the covered period, and the covered period as it is defined now is 8 weeks from the date the loan proceeds are dispersed. So if you got your loan proceeds on April 1st, 8 weeks from that date, as long as that is your covered period and that is the time period that you need to use those funds. So from now on, I'll just be using CP to designate covered period. Like I said, it's 8 weeks from the date the lender makes the first disbursement. Like I said, there's a lot of chatter here. There's talks about pushing it out so that the 8 weeks starts the date of your next payroll cycle. There's also talks about having the 8 weeks start from the date that you resume operations for restaurants and things of that nature, bars if they're closed. But right now it really is from the date the lender makes that first disbursement. And once you're approved for a loan, the disbursement has to happen within 10 days. So that's kind of, it has to come out within 10 days and then your 8 weeks start. And so forgiveness is only to the extent for qualified costs. We talked about that. The costs so you can't get loan forgiveness in excess of the PPP loan that you got. It's kind of interesting. It doesn't really make sense, but it was something in the code basically saying the extent of forgiveness is the amount of loan that you received from the government. Payroll costs have to be 75%. So that is one of the things that is very important. You have to utilize 75% of this for payroll costs. The other 25 can be used for non-payroll costs, but it can only, that's the extent. It can't be a 50-50 ratio. It has to be 75-25. And so there are a couple things that will create reduction in loan forgiveness. So let's say you get a $100,000 loan. In that 8 weeks, you spend $100,000, 75 for payroll and 25 for rent and everything else, and you're good as gravy there, and everything's doing well. Well, let's say prior to the time that you got the PPP loan, you had 10 employees, and at the time that you got the loan, you only had 8. Well, even though you still use those funds for payroll costs and you exhausted your entire PPP loan, because your employees, or what they call full-time equivalents, went down, your forgiveness goes down by that ratio. So instead of getting $100,000 of forgiveness because you only have 8 employees and you had 10, you would only get 80% forgiveness. So that's something to keep in the back of your head. If you did lay off or furlough employees and you said, okay, it's time to come back to work, and they came back to work, that doesn't count against you. If you lay off employees and you go to rehire them and you offer and extend their job back and they decline, that doesn't count against you either. So you just have to make an effort to ultimately rehire the employees that you might have laid off before you got the loan to be able to get that forgiveness, or 100% of that forgiveness. So as we talked about, reduction of employees, if it's reduced, the potential is just the employees in the cover period divided by the employees prior to the cover period. The other thing that can reduce your loan forgiveness, and this is very vague, they haven't come out with final guidance on this, is reduction in salary. So let's say I'm paying Damien $25,000 a quarter, and I pay him $25,000 a quarter in the first quarter of 2020. And then when this happens, I said, you know what, Damien, I can't pay you that. So ultimately, I'm going to end up only able to pay you. Sorry. Dog's barking. So ultimately, if Damien gets $25,000 in the first quarter, and in the second quarter, I can only pay him $20,000. The way that the law is written right now, and absent of final guidance, your PPP loan would be reduced by that difference. So ultimately, instead of being able to forgive $25,000, which was what you based the loan off of, you would only be able to forgive $20,000. And so, like I said, this is something that really has no guidance yet. They're still waiting to figure out how it's going to fall out. But everything that I've read and everything that they've said is that's really kind of what is going to be the case. If you've reduced the salary and wages that you're paying your employees, and you had utilized that amount to get the PPP loan, your forgiveness is going to be reduced by the amount that you reduced in payroll.
Tim, do you have any guidance on, a lot of folks are either self-employed or they're solo entrepreneurs. And so is there any guidance on, can they use 100% of the proceeds for payroll? Do they have to pay themselves do they have to do W-2? Can they give themselves just a check and then it's Schedule C? Like, what's the guidance right now?
So ultimately for them, it's kind of screwy. They've changed things around. There's a couple of things that are a little bit different for S corporations, but ultimately what it comes down to is they can utilize it to pay payroll for them, for payroll for employees. They can use it for rent and everything else, just similar to that. And they can also use it to pay themselves based on what their income was on their 2019 Schedule C. And so it's kind of rudimentary, but as long as they because that's what they're using to calculate it. So as long as that's what they're using and that's ultimately what they're paying themselves, and they've got the forgiveness for that. One of the weird things with self-employed is I saw something with expenses related to interest and things of that nature. For S corporations, interest on debt cover, debt obligations that came into place before February 15, 2020 are covered. For a self-employed person, the interest had to be deducted on the 2019 return to get forgiveness on that loan in 2020. So ultimately, if you entered in a loan in January of 2020 and you're an S corporation, you can use the PPP funds to pay that interest. If you're a self-employed person, you can't. That was one of the biggest issues with the PPP loan was they didn't know how to deal with self-employed people. They said they did, and they kind of came out and they said, okay, well, everyone can apply. Self-employed people can apply 10 days later. And it was because they really didn't even know what they were doing with self-employed and how they were going to do that calculation. And so, really what it comes down to is as long as you're paying yourself based on what you earned in 2019, you're paying salary, and then you're using the 25% to pay the other costs, you should be good. Okay. So I talked about restoration. I'm out of order here. This is kind of the application for forgiveness, and I don't know why I'm so out of order. I apologize. It's a lot of information. Really, to sum it up, for forgiveness, you have to apply with the bank that you got the loan from. So you'll go through a formal application process. And in order to even get the application, you have to submit documentation, and it's documentation. So as you can see, and like I said, I'm not going to go through all this, but payroll, they want payroll tax filings for the covered period. They want it for the period the year prior. They want it for the quarter of the period prior. They want it for February 15th, April 27th of 2020. They want all that information. They want verification of full-time equivalents during that time. For rent and things like that, they want canceled checks. They want payment receipts, transcripts of account, all of that information. And then they want someone to certify that ultimately this is all true, accurate information when they submit that for forgiveness. And once you have applied, and this can ultimately, you can start applying for this once that covered period is over. The lender has 60 days to make a decision whether or not to get the debt or not. So it's hopefully going to be a fast process, and it's going to be something that's going to be easy. But just my point here is this is a lot of documentation. I would recommend maintaining this documentation or starting to gather this documentation now so you could be at the forefront when the cover period ends and try to apply and get it taken care of as soon as possible, because the longer you wait, the more people are going to apply and the longer it's going to take to ultimately get the decision. Okay, so next little thing, this is something that a lot of people have been talking about, the different retirement provisions and things that are in the CARES Act that give you access to funds in your retirement, and ultimately be able to repay them or not repay them and utilize them without the 10% penalty. So the first one is no 10% early withdrawal tax. So as long as the distribution was made in 2020 and it is no more than $100,000 and you have financial hardship from this epidemic or pandemic, then you have the ability to avoid paying the 10% early withdrawal tax. And so if you're under 59 and a half, this is an opportunity. Let's say you're stuck in a situation where you want to pull money out of your retirement plan and you are, not doing it because of the 10% early withdrawal penalty. This is an opportunity in 2020 to maybe get $100,000 out and utilize that to do after-tax investments if you'd like. It can be treated as a loan. And so really you have 3 years to repay it. So if you take the $100,000 out, as long as the aggregate of your contributions to a retirement account, it doesn't have to be the same retirement account, is $100,000 over the next 3 years, and it's considered a loan and it's not taxed. If you do keep it out and never pay it back, then ultimately you have the ability to pay the tax over 3 years. So you can prorate it over the next 3 years instead of paying tax all at once. So this is another opportunity. Like I said, if you pulled the money out and you invested it in something that gave you a $100,000 tax deduction in the first year, you could use that benefit this year and then ultimately pay 33% of the tax this year, 33% next year, and 33% next year. So ultimately give you the ability to use time value of money to get the deduction today and pay the tax down the road. The next opportunity here is plan loans. So plan loans usually were capped at $50,000 and, or the value of your plan. In 2020, so in 2020, from March 27th until 180 days from March 27th, if you take out a loan, you can get a loan up to 100,000. It's really the lesser of 100,000 or your plan value. Again, you have to have financial hardship, so it has to qualify under the guidelines of what financial hardship is. Had COVID, know someone that had COVID, had childcare issues, were furloughed, really anything that affected you during this period of time financially. If you were subject to that, then you meet that financial hardship guideline. And then the other thing with the loans is there is this 1-year moratorium on payments. There's not a lot of information on this. I'm sure Damien probably knows more about this than I do on the moratorium of repayments on the loans. So I would definitely check with him or someone else that is very well versed in the retirement world.
And this, Tim, this is the $100,000 for each one of these. So technically on a plan under 401, like, these 401k type of plans, it's up to 100,000 as a disbursement and up to $100,000 as a loan. So it could be 200 depending on whether the plan allows it. So some plans don't have loans. Some of them are not going to allow it, the disbursement. Individual plans like the EQRP we set up have all those, and it's an aggregate $100,000. If you had 10 different plans, it's a $100,000 loan, $100,000 disbursement. It's not per plan, correct?
Yep, correct. So the last one is they waived RMDs in 2020. So that's a big thing. You don't have to worry about if you were in a situation where you had to do an RMD, you don't have to do that in 2020.
Tim, a cat had asked if there's proof of financial hardship, and my understanding was that the administrator is basically going to say, "Did you have hardship?" and you sign off saying, "I did," and so proof is basically you saying you did. And that last piece that you said, in terms of did you have coronavirus? Did somebody it was like the last one. I remember reading it said something like, in any other Treasury Department something. It was basically a broad-based, if you had an impact, certify you did, and that's it, you're done.
Yeah, I mean, it starts out, and I was going to copy and paste it, but it was just so much information. It starts out with if you had COVID or one of your family members had COVID, and then it talks about if you were furloughed, if you were laid off, if you had to reduce your hours because of daycare issues, if you took a pay cut in salary, if you're a small business owner and there was a reduction of income from your small business. So it really, it just basically came down to, if you're a U.S. citizen and you have a job, chances are you're going to meet this threshold because everyone has been affected by it in some way, shape, or form.
And that's one of the concerns. People, somebody else had asked if you pulled out and you aren't in a hardship, the question is, how could anybody argue that they haven't had an impact? This thing has impacted everybody in some way. So unless you certify that you haven't had an impact, which would be a very strange certification. And then another question was, and I presume the answer is yes, if you're married, you could take up to 100,000 per person for a loan and another 100,000 per person for a disbursement. So if there's two people, potentially up to 400,000 out of retirement accounts.
That was my understanding, yes. Yeah. It's aggregate of yours has to be 100, but yeah, if it's separate ownership, then if you're a controlled group, There's, you know, if you have retirement plans under 3 different companies and they're all controlled group, then that's, you know, that's limited too. But husband and wife should be able to take out 100 each and loan 100 each.
And the disbursement, the 100,000 per person for disbursement, that's for any retirement accounts. That could be IRAs, it could be anything. And the
Correct.
loans are just under the 401 section.
Yeah,
But
they're the only ones
IRAs are
that do.
eligible. Okay,
Yeah.
perfect.
Okay. So this one, I don't know, you know, I talked about this last week. I was on a podcast. This is one of the things that really hasn't got a lot of chatter in the market. I don't know why. The NOL carryback. It is something that is a huge opportunity. I've already utilized it on a client and was able to claw back somewhere on the ballpark about $990,000 in tax that they had paid over 2013, 14, and 15. That individual is going to take that $1 million and go out and buy a $5 million property with it. So ultimately we were able to get that money, you know, when it does come through, but get that money to them, and ultimately before 2020, hypothetically get them a $5 million property that they're going to take bonus depreciation on because they invest in gas stations for some odd reason. And gas stations have a special write-off provision. So they're ultimately able to write off all of the property except for the land in the first year. So she'll get a $4 million write-off in the first year that she's then going to be able to carry back again and swoop up some more of the tax that she hadn't gotten from the 2018 NOL. So as you can see, this is a huge, powerful tool. I don't know why it's not necessarily being talked about a lot, but I kind of want to go over it real quick.
Please.
So net operating loss, really simply, it's defined under Code Section 172. And really what it amounts to is taxpayers' business deductions exceed their gross receipts. So, you know, in layman's term, if you have more expenses, business expenses, than you have income, you're going to have a net operating loss. It does take into account tax deductions such as depreciation and amortization. So there is paper losses that can be utilized here. But really what it comes down to is if you have a business and you conduct business and that business has, you know, all of your business losses exceed your business income, you'll have a net operating loss. Prior to the CARES Act in 2017, they amended the law. It used to be a 2-year carryback and then you carry forward the rest for 20 years for a short period of time. In 2017, they changed that and they waived the NOL carryback and they made the carrybacks or the carry forward indefinite. So ultimately, they can no longer be carried back. It can only offset 80% of your taxable income, but the remainder is carried forward indefinitely. So it's no different than like a capital loss carry forward. You know, you would be able to carry it forward until you utilize it or you die. That would be the only thing that would exhaust your NOL. The CARES Act changed that. So like we talked about, the CARES Act, section 2003 of the CARES Act amended 172 to allow a carryback for 2018, 19, and 20 tax years. And so this carryback is 5 years. And so ultimately a loss that you had in 2018 can be carried back to 2013. 19 is 14 and 20 is 15. And what this means is that if I have a net operating loss in 2018, I have to go back 5 years and then I can go forward. And so let's say I had no income in 2013. I can carry back to 2013. I have no income in 13. It'll carry forward to 14. It'll offset any income I have in 14. If I don't exhaust that entire NOL, carry forward to 15, and it'll continue to carry forward. It'll skip 18, carry forward to 19, 20, 21, and it'll carry forward until it's fully exhausted. Same with 19. It'll start at 14 and work its way forward. And so there's 2 opportunities here. 2019 is kind of a strange year. We're in a situation where a lot of people, you know, we're past December 31st. So the clock struck midnight. So there's a lot of, it's really hard to do reactive tax planning. It's very easy to do proactive tax planning. Things that you can do in 2019 is make sure that you've looked at all your expenses, make sure that you've captured all your expenses. If you weren't going to do a cost segregation study, maybe this is the time to do a cost segregation study on an apartment or a building that you own if you're a real estate professional. 2018, is definitely over and done with. There's nothing we can do. You potentially could amend a return if you found, omissions, but really the thing with 2018 is 2018, they allowed a caveat or extension to file a tentative refund application. And so what they did is they gave us a 6-month extension to file the 2018 1045. And what an application for tentative refund is it's an expedited way to get your money back. So ultimately it's filed typically within 12 months of the tax year that the NOL arrived in. So if this was a 2018 net operating loss, it was due by December 31st. And it's expedited in that you file Form 1045 and it says, what's the NOL? Let's carry it back to 13. How much would it exhaust? Let's move it forward to 14, 15, and it's all done on one form. And the statute of limitations for them to process these funds are 90 days. And so compared to amended return statute's 180 days. So they have to process it quicker. It's much more expedited. And really what it comes down to is they've given us a 6-month window, which ends on June 30th, be able to go back and get money from 2013, 15 within 90 days of filing 1045. If you miss the deadline, this June 30th deadline, you have to file an amended return. An amended return is going to sit on a stack of 50 million other envelopes that the IRS has received in the last 4 months that they haven't opened because they're closed. So an amended return is going to take a great deal of time to process. We're talking this could be a year before you see a refund. It might even be more than a year, depending on how long this lasts. And if they don't open back up, it could be very long on an amended return. So deadline for 2019 and 20 applications for the tentative refunds all stay the same. They're 12 months after the year end. So 2019's 1045 is due December 31st, 2020, and 2020's is December 31st, 2021. One thing that did change, and this is where this is a huge benefit, and this is where this is really what is kind of a game changer with the tentative refund, is everything used to have to be done by paper. You file an amended return, it's by paper. You file a 1045, it's done by paper. IRS is closed right now. IRS isn't processing anything right now. IRS isn't really even doing anything right now. And so if you sent a 1045, it's not going to get processed by paper. If you send a amended tax return, it's not going to get processed, it's paper. But what they did is they opened up a fax line. So they opened up a specific fax line to fax these applications to. And they have created a workforce to process these applications. So this is one of the only parts of the IRS that is still working. They've added employees to this so that ultimately they can process these applications. And what I saw the other week was that they were hoping to be able to process these applications for refund well in excess, or not excess, but instead of 90 days, 60 days, 45 days. So file a 1045 June 1st, you might see your money July 15th. It might be August 1st, but it's not going to be August 1st of 2021. And so, like I said, the statutory deadline is 90 days from submission. So ultimately they have 90 days to get the money to you. It's not to say they will get the money to you. I mean, that's just their statute. If they don't get it within 90 days, they have to start accruing interest.
What's the rate, Tim?
It changes. It's not much. It's like 3%.
Oh.
So, I mean, it's more than you'll get in a bank. And it's, I mean, I haven't seen it. I haven't looked at it recently, so I don't know necessarily what it amounts to right now with all the changes to the interest rates. Like I said, this does not apply to amended returns. So if you're having NOL or net operating loss in 2018 and you don't file this tentative application by June 30th, you have to file an amended return. Then, like I said, an amended return has to be paper filed. individual returns, and it won't be processed by the IRS until operations commence. So if still not working August 31st, they're still not going to process amended tax returns. And when they do open up, like I said, last I saw was about 50 million pieces of unopened mail that the IRS had. They had brought in shipping containers to store. That was about a month ago. So my guess is it's probably more like 70 or 80 million pieces right now. So how can you benefit? So we talked about 2018. That's kind of what can we do if we have it. Let's go back. Let's pull to 2013, analyze if we can utilize it in 2013 and forward. 2019, let's be as efficient as possible. Make sure we button everything up. Make sure that when we're preparing our tax return, we've captured everything we can. 2020, let's be proactive. Let's plan. Let's look at this. Let's look at 2019 before we filed 2019. Maybe I had income in 2019, and yes, I could do a cost segregation study here, but my tax rate's 22%. 2020, well, maybe I do the cost seg in 2020, and I have this other property that I'm buying in 2020, and my business has gone down in 2020. So now if I pull that cost seg instead of doing it in 19 into 20, and with everything else that I have, now I have a net operating loss of $1 million. I can carry that back to 2015. And in 2015, I sold a property and I was in the highest tax bracket, or, business was booming, things of that nature. So as a real estate professional, there's a huge amount of opportunity to proactive planning in 2020. Opportunity to do cost segregation studies, opportunity if things open back up to look at acquiring properties, and think about doing cost segregation studies, thinks about, even as if you're not a real estate professional and you have a ton of real estate, maybe this is the time to sell a underperforming property. Maybe you've got a single family house or a triplex or a fourplex that you've held for years and years and years. It's a dog. You have a couple $100,000 of passive activity losses. Maybe it's time to sell it. It's not performing for you. If you sell it, you're able to free those passive activity losses up, because disposition of activity converts it from a passive activity loss to an ordinary loss. So now, instead of having this $300,000-$400,000 passive activity loss that's locked in, we've now sold an underperforming piece of property. We have cash from that property to potentially reinvest, and we've freed up $300,000 of losses that might generate a 2020 net operating loss that we can carry back to 15 and capture more tax. And so real estate is a great vehicle for creating non-operating losses, and it's a great vehicle to generate income. So ultimately, it's it's uncertain times right now. People really aren't lending. People aren't buying. In a normal economy, I'd say buy, but who knows what it's going to look like in 5-6 months. So first and foremost, make sure it's a sound investment. But as a real estate professional, you've got a huge benefit or opportunity for benefit here. Another opportunity is oil and gas. Oil and gas is really low right now. I don't know if it's necessarily a great investment, but if you invest in an oil and gas well, in a fund, in a working interest, in a well, and you're a general partner, the losses that you generate from that fund are ordinary. And so that's another opportunity, if you can create an ordinary loss from that investment, to be able to offset your current income, create a net operating loss, and maybe carry that back. Another thing is business owners. Business owners have one of the best opportunities here, because they have the ability to, if they can, reinvest in their business. So let's say you're waiting on doing a build out, and you thought, I don't really want to build out my space right now. Great opportunity. Great opportunity to get the capital expenditures, be able to write that off this year. Maybe you're looking at buying equipment, or you're modernizing equipment, or modernizing a process, or, building out something, building out a website, building out a platform. These are all opportunities that will create net operating losses for you that you can carry back to 2015.
Tim, on the capital expenditures, what's the limit? Sure. The annual limit, and also, is this under 179 or somewhere else?
Bonus depreciation. So you could take it under 179. 1099, but this is bonus depreciation. So anything that has a class life of less than 20 years can immediately be written off. It's
And then,
not limited.
and
So
it's okay. This is stuff that you could also potentially finance. So it doesn't have to be cash out of pocket, but like if you did capital expenditures of $1 million, but then you financed all of it, you could write it all off, carry it back 5 years. It doesn't have to be cash out of pocket now, but you could recoup the taxes from 5 years ago if you did that, right?
Yep. Interest rates are low right now if you can get financing. I mean, at the end of the day, in time value of money, if you're in 2015 and 16, we're in the 39.6% tax bracket, and you can carry back $1 million, that's going to save you $400,000 in taxes, roughly. So, $1 million in taxes compared to a 3 or 4% line of credit. I mean, it's kind of a no-brainer in that situation.
And in terms of real estate, one of the things that I think has held some people up, or an opportunity right now, because a lot of lending has changed, and it's getting harder. Something that I did years ago was I just took over mortgages and bought property. So I owned the asset. And so if I did the same thing now, if I went and bought property, I just took over somebody's asset, and used owner financing, you could potentially use all these, the cost seg and the bonus depreciation, and you don't necessarily have to be out of pocket. I'm trying to hammer home this point because there's ways to create these losses without having to have a lot of cash entering the deal, right?
Exactly. Yes. It's just effectively debt gives you basis. And so, ultimately, as long as you've got basis in the property, then you have the ability to write that property off. And so, yeah, I mean, using other people's money is key. Debt is cheap right now. If you can get it, you have a good relationship with a small banker. You've got a long-time relationship with a small banker, or, as Damien said, go out and find people that are willing to sell or finance things. This doesn't have to be, I'm buying equipment. This could be, I'm buying businesses. I mean, you go out and buy a business that has equipment or is heavy in equipment and do seller financing. As long as you do the asset allocation and it's favorable for you, you get to write off the equipment, and most of that will be written off immediately. And so, I mean, that's an opportunity there to be able to get a new business, get an opportunity, grow your business, maybe consolidate, and take some market share from someone else that maybe is in your sector, and be able to take the loss and carry that back to a past year. And
this has come up from a few different people asking about personal income, ordinary income. Is this just specific for businesses, or is this can you talk about that a little bit?
Correct. It has to be businesses. So it has to be ordinary income. So it cannot be, there's several different tests. Capital losses or portfolio income, losses from that arena are capped at that $3,000, or, to the extent that you have capital gains. Passive losses, same. They're capped at the extent you have passive income. If you don't, then they're stuck there and they carry forward indefinitely. Business losses or ordinary losses are the only ones active. Ordinary losses are the only ones that will generate net operating losses for you.
And if it's somebody that's working as a consultant and they're a one-person operation, how does this work for them carrying back losses and things, since they're not maybe an S corp or a corp or whatever another business might be?
It doesn't matter as long as they have a business venture. You don't even have to be a business person. Again, if you go out and you invest in an oil and gas well, and you get a working interest in that, and it throws off $90,000 of IDCs, and you have no other income, you're going to have a $90,000 net operating loss that you can carry back.
What's an IDC?
Sorry, IDC, intangible drilling costs.
Okay.
So, there are opportunities. It has to be a business, so it has to be defined under Code Section 172 as a business, and you have to be active in that business to have it be an ordinary.
Okay.
So, and I mean, really for me, they hit home with that one with the net operating losses. I think everyone should go check 2018, see if they have a net operating loss, and reach out to a tax advisor. figure out what 2013 looks like, look at the benefit, do the valuation, and see if it makes sense. We've been doing them since this came out. I can tell you I've evaluated numerous that have had benefit, and I've evaluated numerous that we've decided didn't make sense. So it really comes down to figuring out what the tax benefit's going to be, and if you are in a high enough tax bracket in 13, 14 to ultimately get benefit from it. Because, and something I wanted to say to touch on that, I've gotten a lot of questions on, well, let's say $800,000 in 2013. Can I apply $1 million net operating loss just to the highest tax brackets and then carry the rest forward to the next year when I was making $800,000 and hit the top tax brackets? It doesn't work that way. It has to go and exhaust, just like you have to have more losses than income in 2018 to create a net operating loss. In 2013, you have to exhaust 100% of the income in that year before you can carry it forward to 14. So you definitely are going to utilize those dollars at lower tax brackets, but hopefully if you're in a high enough tax bracket, you're making $800 million, then you have a lot of the 39, 35 to be able to get benefit before you start touching those lower tax brackets.
Let me roll through some of these questions.
Sure.
One of them from Hans, with the 100% bonus depreciation from the 28 Tax and Jobs Act, what amount of that has to be recaptured once you sell the asset, if any? I'm trying to gain clarity on what exactly is recaptured versus what is not based on the new rules.
100% recapture. So, I mean, I'm going to say it depends. Facts and circumstances. But ultimately, you buy property for $1 million and you write off or take bonus depreciation on $500,000, your new basis in that property is $500,000. You sell that property for $1,001, you're going to recapture $500,000 of depreciation because your basis was only $500,000. Now you sell that property for $800,000, you're only going to recapture 300 of it because 800 minus the 500 basis you have is at 300. There's other things that go into it. And, like I said, it's facts and circumstances. It depends. It's the tangible personal property, valuing that property. There's a lot of nuances that go into it. So the high level answer is yes, you're going to recapture it. The granular answer is it really depends on what your deal looks like.
Okay. Anga asked, do I have to be a real estate professional in the last years to take advantage of the NOL losses? I'm a real estate professional only starting in 2019.
So if you're a real estate professional in 2019, losses from real estate are ordinary. So those would help you generate a net operating loss. In 20 also. But in 2018, if you're passive and you are not a real estate professional, then you would not be able to go back to 2018 to take any benefit from those losses.
Okay. One of the things that, we talked about this in last year, I think, any type of carried interest that somebody has where there's a 3-year rule, and I wanted to maybe just have you throw that out there just because it's a surprise, and you had an example of a client that got killed because of a matter of weeks. And so just putting it out there, I think might help somebody listening right now.
So ultimately with the 2017 Act, they changed the carried interest rule. So it used to be as long as you held the interest. So back up, carried interest. Ultimately what carried interest is kind of your pay for the work you do to improve a property. So if you syndicate a property and you say, I'm going to take 20% of the profits and I'm going to split 80% with all my investors, that 20% is deemed to be carried interest because ultimately you're getting paid based on your work or your effort. And so the old rules were as long as you held the carried interest for a year and a day, it would be long-term capital gains. So I buy a property for $1 million. A year and a day later, we sell it for 1.5. I get 20% of of that cap gain. So I get $100,000. That would be long-term capital gains to me. In 2017, they changed that to now it's 3 years in a day. So in that situation, It would not be long-term capital gains. That would be a short-term capital gain taxed at ordinary income rates. If I held it for 3 years in a day and that gain was $100,000, then it would be long-term capital gains taxed at 15 or 20% tax rates. Even could be taxed as low as 0%, depending on where you are.
So for an example, if you and I did a deal and I brought the deal in and you put up the money, I didn't put anything in, and I got 50% of it, and then we sold it in a year and a day, I would have a 50% carried interest, and that would be taxed at ordinary income, even though it was over a year, because it was considered a carried interest. Is that true?
Correct. Under the new tax law.
So basically, what if I put $1 in? Is there a ratio? I'm thinking about all the people that might be in trouble doing JV deals or anything where they're syndicating even on a minor level, and they get somebody to put up the cash. So 3 years is really important now.
There have been, I've seen, I don't want to use the word schemes. There's been ideas thrown out there of, go ahead and capitalize your carried interest, put $1 in for your 50, for your 50%. And then now it's capital. And since you've owned it for a year and a day, it's long-term capital gains because you put the $1 in. But really, initially, your value and what you're getting is based on the appreciation that you're forcing into the deal. And so even if you put $1 into it or $100, I don't see that would, satisfy the requirements to convert that carried interest, because at the end of the day, it's not 50% of the deal. Like, you're not paying $1 for 50% of the deal. If you and I go into it and we buy a property for $1 million, you put in $1, I put in $999,000. And then in a year and a day, we sell it for $1.5 million. You get 50%. So you would get $250 for your $1 investment. I would get $250 for my $999,000 investment. But let's say in a year and a day, we sold it for $1 million. Well, based on the carried interest or the operating agreement, my guess is you would get nothing because my capital hasn't been returned to me yet. So really, you're only getting paid based on the profit that the company generates, not based on the capital that you put into that company. And so that's kind of where that nuance is. If you always got 50% of the profits, no matter what, and we went out and bought a $4 million property and I put $2 million into it and got a $2 million loan, and we held it for 2 years, paid off a quarter of the loan. And so our profit actually is the amount of the loan we paid off. You're still not going to get, you're not going to get 50-50 because there's no profit in that company.
So when in terms of like these different things, we hear a lot of ideas about people planning and they have strategies around one party gets all the depreciation, one party doesn't, and these different things. Ultimately, is this a good example of form over substance? And
Yes.
When the IRS looks at things, you can say, well, I did it this way, but the essence of it is they're going to say this was the substance of it, even though your form looks good, your substance doesn't cut mustard. Is that kind of a good example?
Yes. So 704 is a section that really deals with allocations, partnership allocations. And 704 has several safe harbor tests. And also, really everything has to have substantial economic effect. So when you go into an operating agreement and you're analyzing an operating agreement, 704 says that as long as the operating agreement has substantial economic effect and it meets these safe harbors, then you have to follow the operating agreement and how the allocations are laid out. If it doesn't have substantial economic effect, then you have to follow the tax provisions. And so ultimately, a lot of these things where people are saying, what, we're just going to allocate depreciation to people that aren't IRAs, and the IRAs don't need it, so we're not going to allocate to them. That doesn't have substantial economic effect. On top of that, you're basically splitting out expenses that you can't split out. So a lot of people talk about depreciation and say, okay, well, it's depreciation, bonus depreciation, and this is just this one bucket, bonus depreciation, and everything else is in this bucket here. And so we can pull bonus depreciation out, and we can specially allocate bonus depreciation. bonus depreciation is just an expense. It goes into the bucket with all the other expenses. You can't pull specific pieces out of that bucket unless the tax code allows you to. Excess business interest expenses they pull out. But ultimately, everything else, it's no different than if you paid property taxes or you paid repairs and maintenance or you paid property management fees. I couldn't say, hey, I'm going to pull out the $100,000 of property management fees that we paid, specifically, especially allocate those to you. And then I'm going to take the tax expense and allocate it to me. And then we're going to allocate this to someone else because it all falls into one bucket. And then we allocate that bucket. Does that make sense?
Yeah, there's been a lot of chatter, especially in the real estate circles, of trying to split the different benefits up. And so I think this is really good for you to be touching on this, because I think people are going to get into trouble that are getting creative, but I think people are playing with fire. At least that's what my interpretation of it was, because they're not just putting it all in the same bucket, they're moving buckets around.
Yeah, and it also, I mean, it goes substantial economic effect, but then it also is risk of loss. I've seen a lot of people, a lot of syndicators, and worked with a lot of syndicators that they say, you know what, I want all the loss. Like, I'm the one putting the effort in. I want to figure out how I can get my loss. I've put no capital into the deal, but I want my loss. And that just doesn't, they don't have an economic risk of loss. The people that have the risk of loss are the people that put the capital in first and foremost, and then in proportion to the debt, whether it's recourse debt or qualified non-recourse debt, they have risk of loss. But ultimately, you have to look at that. And I've seen a lot, and I've actually seen a lot of tax returns that have ended up having to be amended because people are allocating. I saw one where they had $2 million of losses from bonus depreciation, and they allocated 100% of those losses to the carried interest people, and none to the people that put in the capital. And it was just, it was jaw dropping. Number one, the CPA that prepared didn't even read the operating agreement, because the operating agreement specifically said that you couldn't have an adjusted capital account deficit, meaning you couldn't allocate losses to people that didn't have capital accounts prior to allocating losses to people that actually had capital accounts.
I think that's one of the strategies I've heard with people that are raising money from retirement accounts, because the retirement accounts don't have depreciation benefits, and so they were trying to get the depreciation benefits to someone that could use them. So that's what I've heard in terms of this strategy, moving things around, cutting it apart.
I mean, you could potentially think about doing different member classes, but again, it all comes down to substantial economic effects, and you've got to look at it. I always go back to, you and I are in a partnership, and I'm going through a bitter divorce, and so I don't want to show that I have any income. I can't just say, you know what, I'm going to allocate everything to Damien. So Damien, you're going to pick up all the income, and I'm going to still take a 50% share of the distributions. There's no economic effect for that. I mean, there's no reason for it, because you have the income. Hypothetically speaking, the money needs to follow you. And so to be able to say, okay, well, we're going to split up this specific expense and just allocate it to B class and not to C class, that doesn't have substantial economic effect. And I truthfully don't think it passes the safe harbor test, and it doesn't pass the smell test. I mean, I think if the IRS were to audit it, it would get, if you had a qualified, competent auditor, you would probably get dinged with that.
A couple of some other questions that came in. Stephen asked about two things. Do you recapture at capital gains rates, and what happens to the depreciation that IRA investors can't use?
So it's depreciation is just an expense, so it's a loss. So hypothetically speaking, they're no different than an individual taxpayer. If they have a loss that they can't use, it will carry forward. And so when you're filing and tracking with an IRA, you need to potentially have to file a 990T. If you're memorializing and capturing those losses, they should offset the UBIT income that you might have in the future. If it's a true cash deal, then it's an expense that's, at the end of the day, it's an expense that's lost. It's a loss that didn't get utilized because the IRA has no taxation.
Which and to be, to take it full circle with any type of retirement account, if there's depreciation and you feel bad because your retirement account's investing, if that deal exits in 4 or 5 years, you don't have a recapture event at that point. So it's kind of, depreciation is sort of a moot point when you're in and out of a deal, because you're going to end up recapturing it anyway. So I always say it doesn't really matter if you're going to be out in 5 years, because this is tax neutral inside the retirement account.
Yep, exactly. And to answer Steven's question, I just drew a blank. What was it? Capital gains. So recapture, it depends. So it depends on just factors. It could be recaptured, so there's various different things. Business property falls under Code Section 1231, and as long as you hold business property for a year and a day, all gains from 1231 are capital gains. But ultimately, if you do have recapture, it would be recaptured at potentially capital gains rates as high as 25% if there is depreciation recapture. But again, it's facts and circumstances. It just really depends on what's going on with your current situation.
One of the questions too by a lot of the real estate investors, if someone has rental units but not a formal business entity, basically they're filing Schedule E for their income, is the NOL applicable for the carryback, or is that?
It is. It is, as long as, so real estate in the tax law, real estate isn't defined as a business. So real estate doesn't fall under Code Section 162. And so in order to have it become a business, you have to be a real estate professional. So you have to make the election to be a real estate professional. If you make that tax election to be a real estate professional, then you're ultimately taking that non-business activity and turning it into a business activity. So even if it's reported on your personal tax return, as long as you're a real estate professional and those properties create losses, they would create a net operating loss. If they're passive and you're passive in the investments, then they're just passive losses that you won't be able to utilize.
So when somebody has Schedule E, that's basically their real estate isn't a business, it's just an investment. If they wanted to actively engage with the property manage, doing repairs, that kind of stuff, and shift income from Schedule E to Schedule C, does that change the nature?
No. You would never put rental property on Schedule C. So
if you I guess if you were shifting income and you were trying to create ordinary income, is there a way for people to do that? Is there any good reason to do that?
I mean, you definitely could, but again, I mean, if you're passive in the business and you're managing and you don't meet the real estate professional designation and you're taking money from a passive entity and creating a passive loss, you're not going to be able to offset the income on Schedule C from that loss. So ultimately you're paying tax in a year that you shouldn't be paying tax. It's very akin to, I see a lot of times, and this is kind of off topic, but people that have S corporations, and I see, someone has an S corporation with a $90,000 loss and they paid themselves $100,000. You just ultimately created a situation where you funded a loss to pay yourself a salary to pick that up in income. Now, hopefully you're in a situation where you don't have debt in that S corporation, you can't take the loss. But, really, if you're in a loss position, you shouldn't be trying to move money through other channels to get it into ordinary income, things of that nature, because at the end of the day, you're just taking it from your left hand to your right hand. And if your left hand's passive and your right hand's active, you're not going to be able to put them together. You're just going to be separate.
Got it. Let's see if there's any other bigger questions. Do you have any additional slides or?
Yeah, I have one last one. This was really it. A couple other miscellaneous things. Charitable contributions. So for 2020, they got rid of the 60% AGI limitation as long as it's cash contributions and it is made to a qualified organization. So a church, a charity, any 501c3 qualifies for that. And so if you give $1 million of cash to a charity and you have $1 million of income, you should effectively be able to offset that $1 million of income with that $1 million donation. One caveat to that, and a lot of people use donor advised funds. Donor advised funds don't qualify. And so you can't put $1 million into a donor advised fund and $100 or 100% write off. it will be capped at the 60% that it would have been capped at under the old tax law. And so the last piece is a technical correction. So with the 2017 Tax Act, they kind of forgot to identify what qualified improvement property's life was. And so under the old tax law, you heard of like qualified improvement restaurant property, things of that nature, was designated 15-year assets, which under the new tax law would qualify for bonus depreciation. They just forgot to classify it. And so in absence of classification, it fell to, it is non-residential property depreciated at 39 years. And it didn't qualify for bonus depreciation. So they did a technical correction and said it is now classified as 15-year property. And so if you have done any improvements to commercial properties that would qualify as qualified improvement property, you can now go back and write those off, or going forward, you can write those off. They are eligible for bonus depreciation. That's really it. That's everything. I know is a mouthful and a ton of information. I tend to get carried away.
And let's see if there's any other questions that we can answer. Some of the questions that came in, I think would be probably really good directly to Tim or to your CPA. You guys can reach out to Tim and the team at ProVision with these websites. Let me see if there's any other questions that might be useful for everybody.
And definitely, yes, reach out to, everything here is, is based on it being in a vacuum. There's a lot of facts and circumstances, and everyone is individual. Everyone's picture is a snowflake. No one's have the same. So make sure that you are identifying and speaking to, a qualified professional about these, and make sure that they, are able to give you all the information that they can and individualize for your specific situation.
And you guys, I can tell you from experience that not all accountants are made equal. A lot of people just kind of do returns. They're not really strategists. And it's also incredibly dangerous to do what I did when I was starting out for a while, where I was the strategist because I was good at reading and doing research. It's more than that. It's having people, it's having true experts that are going to think about things and around the corners and have the experience of not letting you get away with dumb things, but coming up with creative things that are actually going to pass through potential audits and things. And so that you're not afraid of them, but you're actually thinking bigger. So having the right people on your team, like Tim, it will change your absolute life. I mean, I can tell you it's more interesting and fun to think about taxes when you've got a team. If I just had, like I did years ago, having somebody that was just a random tax filer, it's kind of depressing and scary, because then I have to be the expert, and that's not, I don't want to do that. And I know a lot of you guys would be better off and happier in your lives if you had somebody that you knew was part of your strategy and that you didn't have to be in charge of knowing everything about everything. I think that's incredibly stressful and probably pretty stupid.
Yeah. At the end of the day, I mean, it all goes to focus. I mean, everyone's good at their roles and making sure that you find people that fit those roles. If you're a real estate professional, you're a doctor, you're, whatever you might be, that's your little section of qualification. And that's the area that you should really be spending your time focusing on. And find a tax professional or someone that really devotes their time and effort to understanding and educating themselves and, people that they work with of the tax law. A kind of an antidote, when this all happened and we closed down our office March 16th, and then they extended the deadline to July 15th, we kind of thought, okay, well, we're going to have somewhat of a lull. We're going to have a hard time. We need to reach out to our clients, get business, get working, get everything in. And then they passed these laws and these acts. And everyone in the firm spent the next 3 weeks either on the phone, talking to people, in seminars, educating themselves, reading material. As a whole, I would say I probably put at least 100 hours of education into the CARES Act to date, just so I can understand and really understand everything. We've done in-house CPAs, CPEs, or continued professional education. So really, it came at a good time because we did have that lull, but it really filled up that time. So, it's really hard to keep on top of the new tax laws and as they change. I mean, we just got used to the 2017 Tax Act, and they just threw this in, and it's changed a lot. It's changed a lot of things, and the Tax Act that they're talking about now could further roll back stuff that was in 2017, bring back meals and entertainment, do things of that nature. And so, if you're a professional and you're doing what you love and you enjoy, focus on that and let someone else that's, a qualified tax advisor help you.
I totally agree. A couple of the questions that came in, I think they're kind of new topics, and I think that'd be useful. Any insight you have? One was for high earning salaried people that are also investors. We have some mutual clients that are doctors, for example, that make $300,000 to $800,000 a year, and so the question is, I've been informed that if you exceed a certain income level, you're not allowed to claim losses. So you'd mentioned oil and gas and some things. What are any other ideas or thoughts to that question, or any ideas?
So one of the other thing that so in 2017, they came up with this idea, the Tax Act came up with this idea of excess business losses. And it's really complex and complicated, but really the easiest way to say it is if you had $1 million loss, it could only offset up to $500,000 of non-business losses. So if you had non-business income. So if you had a capital gain from stock sales, if you had interest income, if you had an IRA distribution, if you had $1 million of net operating loss from a business, you had $1 million of distributions from an IRA, you would still pay tax on $500,000 because your losses were capped at $500,000. They did away with that with the CARES Act. So that's no longer the case. Excess business losses went away. So that was the other thing that they changed, is they did away with that. So if you did have, and another caveat to that is when the 17 Tax Act came out and the taxation, or the Joint Taxation Committee released their blue book, they had said that they never intended to include W-2 earnings as a business in that calculation. The IRS came out and said, well, we really don't care what you're saying. We're going to lump that in. And so after the fact, they brought W-2 wages in and said, in our opinion, being an employee is a business. And so you're in a situation where if you've got a real estate professional that's, wife or husband that has $1 million loss, and you have a doctor, wife or husband that makes $1 million, you could hypothetically offset the two and not pay any tax. Where if it was interpreted as the way that Congress wanted it to be interpreted, you would have to pay $500,000 of, you would have taxable income of $500,000 because of W-2s not being business.
Did that also change then the ability that it used to be that if you had losses from bonus depreciation from different things, that you could use up to $500,000 of that to offset conversions into Roth? And so now is this to where you could
do $1 million. Yeah.
You could do unlimited. You could have $10 million and you can convert it if you had $10 million. So now you can convert as much as you want to Roth and use other losses. That's a big deal, you guys, for any of you that have retirement accounts. I know a lot of you do, because the idea is to find ways to get to Roth. I mean, that's the game.
Yeah.
So, wow.
It was a huge thing. And, I saw, we ended up having to go back and amend tax returns where we had prepared them based on, the guidance we had at the time that said W-2 wages are not business income. And so they paid taxes, and then we had to go back and amend it when the IRS released their guidance to bring that in. But yeah, the CARES Act got rid of that. I don't know if it'll come back, but they said it was no longer.
And can passive loss carry forwards be used to offset tax on COVID IRA distributions?
No.
So a distribution is going to act as normal income. So wouldn't losses be able to be used to offset that income?
Not passive losses. It's a different bucket.
Passive loss. Okay, good.
Yeah, passive losses, they're in their own little category. They can only offset passive income.
And one of the things that we've been talking about a lot, if somebody takes out money for a disbursement, they've got the two options. Either they can put it into any type of qualified plan within 3 years, or they can pay taxes on it over the next 3. What if the plan is that they're going to put it into a plan. They're going to, basically do a rollover in 3 years. And the end of 3 years, they go, oops, I don't have the money, and they have to pay taxes. If they didn't pay taxes over the previous 2 years, do you expect there to be some type of penalty or something?
I don't know. There's no guidance on it yet,
That's
unfortunately.
Yeah. So those of you that have asked me that, nobody knows yet because there's no guidance.
Yeah, I mean, it's been very generalized. It really just says you can pay it back within 3 years, but it doesn't say what that looks like, because exactly like you said, what if I said, you know what, I'm going to pay it back, and then you never have the ability to pay it back? Do you have to pay tax in the third year?
We don't know. It's also an interesting thing because the way the CARES Act was written, it says it must be returned. It must be put into a qualified plan within 3 years. This is typical of rollover rules that are normally 60 days. So basically, it allows you to pull it out of an employer plan that you might be working at a W-2 job where you normally couldn't tap into it, pull it out, and then roll it into a self-directed type of plan. So that's an interesting twist. It doesn't say it has to go back to the same plan. It says it has to go to a qualified plan within those 3 years. So
yeah, and it doesn't have to be, you could put 10,000 of it in this year and 90,000 in 3 years. It doesn't have to be all at once. It doesn't have to be in the same account.
This is a really good opportunity for a lot of people to be able to get money out of the mutual funds and into like an EQRP where you can actually direct it into real estate. Whereas before you're just sitting there going, I can't touch this money until I leave my job. Now, potentially, likely, you're going to be able to pull out 100,000. So something to think about.
At the end of the day, I mean, depending on what your intent is, I mean, another opportunity is, if you can't get the money out because let's say you've got $500,000 in there and you intend on creating service at some point, you can take out the 100,000, and you can also take a loan of 100,000. And when you separate service, you just end up paying tax on that 100,000 was a loan that you didn't repay. And so, it's an opportunity to potentially get $200,000 out in that opportunity and roll that 100,000 that you took out as a loan into another plan or use it. I mean, there's just a lot of little things that you can do with that.
Yeah, a ton. And again, you guys, there's a lot of nuance here. So any of the retirement stuff, ProVision or anybody at our company, at EQRP company, can help you with the nuance, because it can get totally confusing because there's a lot of things. And if you're not doing it every day, you don't want to make a mistake with this stuff. And you don't want to miss something too. I mean, some of these things are pretty big deals. Like the loan is only available until September 27th. Well, if you think that everything is through this year and you try to do something in October, you're out of it. So just make sure you're connecting with the people that are doing this. One other question from Delmar: any tax strategies for selling properties besides 1031s? Any other strategies for I guess doing something similar that might be out there?
Not really. I mean, it depends on what your goal is and what you're trying to accomplish, because a lot of times maybe, you don't want to do a 1031 exchange because you can just throw that back into another property and be able to do a cost seg and write that off. Maybe you're going to take the gain from that property and put it into an opportunity zone and be able to defer the capital gain for 7 years. I mean, it really depends on what you've got and what your options are, and really just figuring out what looks best to you. A 1031 exchange, if your gain's less than $100,000, it might not even make sense to do a 1031 exchange because it's just an additional expense.
And you guys, I've seen a lot of people over the years. In fact, I watched a lot of them buy my properties in 2005. People were so anxious to avoid taxes, and they thought the only option was a 1031. So they ended up buying dumb assets, overpaying for them, instead of looking at maybe paying capital gains or finding other things with people that could think through it, like Tim. So just because we've heard about things like 1031s for years, and that's the knee-jerk reaction to avoid or kick the can, doesn't mean that's necessarily the best thing with cost seg and all these other strategies. There's a lot more on the table, and you need honestly, you need a team to figure this stuff out together. I mean, this is
it comes down to analyzing everything and making sure that you have someone that can help you analyze things, because everyone is different. Every situation is different. It might look, you sell property A this year and property B next year, and they have the exact same characteristics, it might make sense to do a 1031 this year and not next year, just simply because of the other income you have. A lot of people don't realize that as a married couple, the first $70,000 of income, if it's capital gains, is taxed at 0%. So, let's say you have $100,000 of taxable income and it's all capital gain. You're not going to pay any tax on that because the standard deduction is $24,000. And so at the end of the day, you have $100,000 really to play with, wiggle room to play with. And so if your gain's $110,000, does it make sense to do a 1031 exchange? But let's say next year you have a $200,000 W-2. Well, now you're going to be taxed at 15% because your income's over that $70,000 threshold. And so maybe it makes sense if you're going to pay 15%. But it's really just kind of looking at everything and doing proper planning. I mean, I think that's if I were to take anything and say that this is one major takeaway, is make sure that you're doing proactive planning. Because if you don't do proactive planning and if you don't analyze what you're doing, you can never go back and fix it. If the game's over, you're not going to be able to change the score. So you want to make sure that you're doing everything you can during that game to drive down your tax liability as much as possible, because the second clock ticks, December 31st, 12:01, you're done.
And you guys, something that's come up recently, and I think it's really important, and it's going to apply to you personally or just in general. Some of these things are going to have unintended consequences, like allowing people to pull money out of accounts, of retirement accounts. Really awesome. And there was a question about, does it make sense to pull out $100,000 even if I don't know what to do with it? Maybe, maybe not. I mean, unfortunately, a lot of people are going to pull money out, and it's not going to be in an account 20 years down the road, and there's going to be a problem. But you know what? This is where other people help you think through this stuff, and having access to capital. I mean, this has been said by a lot of people. Having access to capital right now, given what's coming and where we're going, is really important. But having access to it and then doing something stupid is not going to help you. So you want to make sure that you're doing something, even if you don't know what you're going to do. Make sure that you have access to resources and that you're utilizing those smartly. And that's what we're all here for, is to help you think through that stuff. I mean, that's what Tim has done with us, and he does with a lot of his clients and people. So if you guys have the opportunity to work with Tim, to talk with Tim and everybody at ProVision, I think you're going to realize what I've been talking about and why I'm so impressed. And just make sure you're not doing this on your own. I mean, I don't care how smart you are. It's better to do things with a team, and that's what business is. It's a team sport. So find those people. And Tim, anything else you want to throw in here? I mean, you've been awesome. I appreciate your time and everything. Anything else you want to share with everybody?
I mean, I know this is all about taxes and my life's all about taxes, but to Damien's point, don't do anything. Don't ever let the tax tail wag the dog. Make sure that everything that you're doing is sound and it has a sound purpose and investment strategy behind it before you do it. I see a lot of people that do things just to save on taxes. And at the end of the day, it gets a lot of people into trouble because they're saving 3 cents on every dollar that they spend, and they're spending money in bad investments. So always make sure that you're doing things and you've got a strategy in place and you're looking at and operating soundly before, utilizing any of these tax strategies.
Awesome. You guys, this is going to be shared. If you got an email inviting you, I'm going to share this out by tomorrow. So feel free to watch it again, share it with other people. Tim's information's here. Please reach out to him. And, thanks for showing up. Thanks for hanging out. We do have another event on Thursday. If you got an email about that, hope to see you there. And we'll keep doing this as things evolve, because we've said if there have been a few things that have come up where we don't know yet, there's no guidance, or things are going to change. Congress is going to have trillions more in spending. As these things change, we'll keep providing information to you guys. We'll do more webinars, we'll email. So we're gonna keep in front of this and keep educating you guys, and we'll do this as a tribe. Make sure that we're supporting each other and navigating through these waters together. So until we see you guys next time, thanks for having part of your Tuesday night with us, and we'll see you guys soon. Thanks, Tim. Appreciate you being here, man.
Thank you, Damien.
All right, guys.
Good night, guys.